These are 9 top big cap stocks with large percentage gains today. Our review on HTZ. Hertz Global Holdings Incorporated is a global car rental and mobility services company best known for its Hertz, Dollar, Thrifty, and Firefly brands. With over 11,000 rental locations across 160 countries, it's one of the most recognizable names in the space. On top of that, they got Hertz car sales for used vehicles and a car-sharing business over in Europe. But lately, it hasn't exactly been smooth sailing. After a rocky stretch post-pandemic, bankruptcy, and a 35% slide over the last year, the stock had been trading like a shadow of its former self. That is, until today. The stock absolutely exploded, jumping 56% during the day. And if you include the late-day surge and continued momentum after hours, it marked a staggering 105% breakout from late regular trading into after hours. That's the kind of move that makes you take a step back and ask, what just happened? Well, it turns out activist investor Bill Ackman is back in the spotlight, and he just made a bold bet on Hertz. His firm, Pershing Square, disclosed a major stake, initially listed as 12.7 million shares worth over $70 million. But just before the market closed, CNBC reported that Pershing's stake might actually be closer to 19.8% of the company, thanks to a confidential treatment agreement with the SEC that let them build their position quietly behind the scenes. That kind of surprise, especially when it involves someone like Ackman, lit the match. Now, this isn't just a random pop off a headline. This feels like the market re-rating the story. Ackman is known for stepping into troubled companies, shaking things up, and often coming out with some serious wins. He's not in this just to buy low. He's in it to push for transformation, and investors are clearly betting he'll do the same here. And given Hertz's size, its global footprint, and its struggles since the bankruptcy era, there's definitely room for a turnaround story. It's also interesting that Ackman's move might be partially a macro bet. With tariffs on imported cars potentially driving new car prices higher, used car inventory like Hertz's might gain value. And that could be a smart angle given their car sales business. So there's a fundamental underpinning here, not just a turnaround hope play. Of course, Hertz still has a lot to prove. Their Q4 results were disappointing, and they've been in the middle of a big reset. The company has said it's focusing on stabilizing the business and setting the stage for a bigger transformation in 2025. We'll get our next look at that progress when they report Q1 earnings after the close on May 12th. Analysts are still expecting a loss, so there's no sugarcoating the fact that they're still in recovery mode. But for now, the Ackman effect is in full swing. This was one of the most dramatic one-day turnarounds we've seen in a while, and it's giving investors something Hertz hasn't seen much of lately. Hope. The stock has people talking again, and maybe, just maybe, it's the beginning of a real comeback chapter for the iconic rental car giant. Our review on ZEO. Zeo Energy Corporation is a vertically integrated player in the residential solar space, offering everything from the actual solar panels and energy-efficient gear to the installation and long-term servicing. Basically, they're one of those one-stop shops for homeowners looking to cut down on energy costs or go green, serving places like Florida, Texas, Ohio, and a few other key states where solar is really catching on. Now, let's talk about what just happened with the stock today because it was wild. Zeo absolutely ripped out of the gate with a 70% breakout right at the open and held strong to finish the day up 55%. That's not your average rally. This was a rocket launch. We're talking major momentum, and it wasn't tied to a press release or new earnings drop. So what's driving this? When you see this kind of explosive move, especially in a name that's been flying under the radar, it's usually one of few things: short squeeze, momentum breakout traders jumping in, or whispers of something coming. Zeo's been a lower volume, lower float type of stock, which makes it extra sensitive to a flood of buying interest. And once that early morning breakout hit, the algos and retail crowd piled on. But beyond the price action, There's actually a story here that could be brewing. Zeo is sitting in the middle of a sector that's got some serious tailwinds: renewable energy, rising utility bills, and new tax credits in play. States like Florida and Texas are big battlegrounds for home solar growth, and Zeo already has boots on the ground. No official word yet from management, but this kind of move doesn't go unnoticed. So whether it's a technical breakout or traders positioning ahead of a potential announcement, today's surge was loud. For a company trying to power more homes with clean energy, this could be a breakout moment, not just in price, but in visibility. Our review on ELPW. eLong Power Holding Ltd is in the business of high-power lithium-ion batteries. Think electric vehicles, heavy machinery, and big-time energy storage systems. They're not just making batteries for gadgets or scooters. They're focused on the heavy-duty side of the battery game. Their tech spans lithium manganese oxide and lithium iron phosphate setups, which are solid options when you're dealing with high performance and long cycle demands. Basically, if it needs serious power or long-term energy storage, eLong wants in. Now, let's talk about that stock move, up 48% today. That kind of spike doesn't just happen quietly. There wasn't a headline flashing or a major earnings drop, but this kind of run usually has a reason, even if it's just momentum catching fire. In markets like this, where battery tech and clean energy plays are always one catalyst away from getting hot, a move like this grabs attention fast. Whether it was a short squeeze, a breakout off a technical setup, or just traders piling in ahead of some expected developments, eLong suddenly landed on a lot more watch lists today. And in a sector where investors are constantly on the hunt for the next big battery stock, a near 50% surge in a single day will turn heads. The takeaway? eLong's not just drifting higher, it just made a statement. No confirmation yet from the company or fresh news, but when a battery maker tied to EVs and energy storage rips like this, you can bet people are sniffing around for what comes next. Our review on AREN. Arena Group Holdings Incorporated is a tech-driven media company that's all about building digital content ecosystems. Think of it like a next-gen publisher. They own and run media brands, support third-party publishers, and give content creators tools to manage and distribute their work. They've got everything from publishing tech and video platforms to newsletters and machine learning recs, all designed to pull in readers, keep them engaged, and turn that traffic into revenue. Now let's get into what's moving the stock. Up 38% today after a surprisingly strong earnings report. Arena dropped Q4 numbers showing an EPS of 14 cents, flipping from a loss of 23 cents a year ago. That's a serious turnaround on the bottom line, even though revenue did come in lighter, down to $36.2 million from $44.1 million last year. But here's the thing. Investors seem way more focused on the profitability shift than the dip in top-line sales. What really caught attention was their CEO talking about this new competitive publishing model they rolled out. It's basically a 24/7 newsroom strategy with multiple teams competing to break stories first. They've tested it on Men's Journal and are expanding it to Parade and The Street. Early results? Apparently solid enough for management to confidently project profitability in every quarter of 2025. That kind of guidance hits different, especially in digital media, where turning a profit isn't always guaranteed. Combine that with a big bottom line beat, and you've got a cocktail for a major stock pop. Today's 38% move feels like a market waking up to the idea that Arena might actually have a playbook that works in this messy digital media space. It's still early, but if their model keeps delivering, we might be seeing the start of a legit rebound story here. Our review on ZYBT. Zhengye Biotechnology Holding Ltd is a company focused on the animal health space, specifically through developing and selling veterinary vaccines. Their bread and butter is vaccines for livestock, swine, cattle, goats, poultry, you name it. They've built a diverse portfolio with over 40 products, including everything from monovalent to polyvalent and combo vaccines, which gives them solid coverage across a range of diseases and animals. Their business spans both domestic and international markets, which gives them a bit more runway when it comes to scaling. Now, the stock jumped 32% today, and while there wasn't a big flashy headline driving it, moves like this usually suggest something's cooking, either under the radar or brewing in investor sentiment. Sometimes in the biotech space, especially with companies in niche areas like animal health, momentum can build around whispers of upcoming approvals, contract wins, or even just renewed interest in undervalued players. It could also be tied to bigger macro trends, like increased attention on food safety, livestock health, or even a broader rally in the agri-biotech sector. But a 32% move on the day, that's more than just noise. It's the kind of spike that makes you take a second look and ask, what are people seeing here? So, while there's no official catalyst yet, today's action suggests investors are starting to wake up to Zhengye's potential. Whether it's speculative, forward-looking, or based on real developments behind the scenes, we'll probably find out soon enough. But either way, this kind of move doesn't go unnoticed. Our review on NioCorp Developments Ltd is a mineral exploration and development company with its eyes on a pretty unique slice of the critical minerals pie. Their main focus is the Elk Creek project in southeastern Nebraska, a shovel-ready development with one of the highest-grade niobium resources in North America. And it's not just niobium. They're also looking to extract scandium, titanium, and potentially some rare earth elements, which positions them right in the middle of the critical minerals conversation, especially with growing geopolitical concerns around supply chains. Now today, NioCorp stock shot up 31%, and while there wasn't a big headline splashed across the news, a move like that doesn't happen without something stirring in the background. This kind of jump could be tied to renewed investor interest in critical minerals, especially as the U.S. continues to prioritize domestic sourcing of materials needed for things like EVs, defense tech, and advanced manufacturing. Niobium and scandium might not be as buzzy as lithium, but they're essential for high-performance alloys and clean energy tech. There's also the speculative angle. Maybe something new is happening behind the scenes with permitting, financing, or even strategic partnerships. This is a project that's been inching closer to reality, and a surge like today could signal that people think it's about to cross an inflection point. So, while we don't have a press release to dissect, that 31% pop definitely speaks to a renewed sense of optimism. Investors might be betting that NioCorp is finally getting closer to unlocking the value of Elk Creek. And if that's the case, today's move could just be the beginning. Our review on DLHC. DLH Holdings Corporation specializes in providing high-tech solutions to the U.S. federal government, focusing on areas like health, defense, and digital transformation. They're involved in everything from systems engineering and cybersecurity to AI, machine learning, and even clinical trials. The company works closely with major agencies like the Department of Health and Human Services and the Department of Defense to help improve healthcare systems and defense capabilities. Now, here's why investors are buzzing today. The stock is up 27%. This kind of rise often points to something shifting in the market or the company's outlook, and it's likely tied to the growing need for the kinds of services DLH provides. The government is ramping up spending in areas like cybersecurity and digital solutions, and DLH is positioned right in the sweet spot to benefit. In particular, their expertise in cutting-edge technologies like AI and big data analytics could make them a key player as the government continues to digitize and modernize operations. If they're winning more contracts or catching the eye of larger investors, this rise makes a lot of sense. It's definitely a name to watch, especially if you're keeping an eye on government contractors in the tech and defense space. Our review on HOLO. MicroCloud Hologram Inc. is a company that's deep into holographic technology, offering services like high-precision LiDAR solutions, holographic imaging, and advanced driver assistance systems. They're working on some pretty cutting-edge stuff, especially with their holographic LiDAR sensor tech and 3D object capture through digital twins. But here's the issue. They've got great tech, but turning that into actual growth and revenue has been a bit of a struggle. Now, here's why we're talking about them today. The stock's up 24% after the company announced a bold move, a 1-4-40 reverse stock split, effective later this month. What's a reverse stock split? Basically, they're consolidating shares, so for every 40 shares you own, you'll now have one. The hope is that this will boost the share price enough to meet Nasdaq's minimum listing requirement of $1, which is something they've been struggling with. At the time of the announcement, the stock was well below $1, deep in penny stock territory. In theory, this could help attract new investors or even institutional interest, since a higher price per share might look more appealing. But let's be real, reverse splits are often seen as a last-ditch effort to stay alive on the exchange. It's a short-term solution to a bigger issue. The company's been in free fall, with shares plummeting nearly 99% over the last year. Even though MicroCloud holds a bunch of patents, including some really impressive ones, they've yet to translate that into any big commercial wins or profitable deals. And their competitors in the holographic space? They're holding steady or even growing, while MicroCloud has been sinking. So, while the reverse split might give the stock a short-term boost, the bigger question is whether this company can really turn things around. They got the technology, but without a clear strategy for turning that into real business success, the reverse split might just be a temporary fix. Investors should be cautious. This move could buy some time, but unless they can start converting all that innovation into actual revenue, it's just putting off the inevitable. If you're thinking about investing here, keep an eye on whether they can turn things around, or if it's just another case of innovation without execution. Our review on FATN. FatPipe Incorporated is in the business of providing secure, enterprise-class SD-WAN solutions, helping organizations like enterprises, government bodies, and communication service providers manage their networks more efficiently and securely. Their software solutions are built for today's cloud-driven, hybrid environments, offering everything from SD-WAN and SaaS to network monitoring services. FatPipe's focus is on helping businesses run mission-critical applications securely across diverse networks, whether on-premises or in the cloud. Today, the stock has jumped 21%, and that's certainly catching attention. Now, when you see a move like that, it could signal a few things. Investors might be reacting to a new contract or partnership, or maybe the company is making waves in a growing sector. With a rise in demand for secure cloud services, companies like FatPipe are positioned well in the SD-WAN space, offering robust solutions for businesses that need to stay secure while managing complex networks. But a 21% rise? That's a pretty significant uptick for a company like FatPipe, which, while impactful in the networking world, has often flown a bit under the radar. This could be a sign that investors are finally catching on to the potential in the software-defined networking space, particularly as cloud adoption continues to grow. SD-WAN solutions are at the heart of helping businesses build more resilient and secure networks, which is becoming a must-have in today's remote-first world. That said, while the jump in stock price is a positive sign, it's important for investors to keep an eye on the company's ability to convert that demand into long-term contracts and sustained revenue growth. The networking and security space is competitive, and while FatPipe offers solid tech, it's up to the company to keep building momentum and securing that steady stream of business. For now, that 21% gain seems like a nice little validation of their market position, but investors should watch how things develop over the next few quarters. Please subscribe, give the video a like, and watch more from our playlist. Thanks.